When you see something is mispriced, either too expensive or too cheap, as an investor, you have the option to either buy it or bet against it. If this company is undervalued, I'm looking at the balance sheet, I'm looking at the income statement, and I know that in 1, 2, 3 years, you never know for certain, but I have really strong confidence that in a year or 2 or 3, they're going to be able to get contracts with these big companies, and all this stuff is going to be great, and the revenue is going to go from $1 billion a year to $5 billion a year, and profit margins are going to go from $200 million to $2 billion. If you can find a company like that and you can buy it cheap, that's ways to make generational wealth. What's going on, everybody? My name is Ben Berman, and welcome to the start of this series on my thoughts on investing and financial education. So, a little bit of background about myself and why I'm speaking about this. I've been investing in the stock market for around 10 years now, and I've been investing in the crypto markets for a little bit over 8.5 years. In that time, I've learned a lot. I've had a lot of experiences, many positive, many negative. And one common theme that I have really encountered over and over again when talking to people about investing, and I've been kind of a full-time professional investor for about 2 years now. One common question I get is, how do you know what to buy? How do you know what to sell? And, there's this perception that the market, there's a lot of gambling, right? And I want to take this video to address like the most fundamental core question when it comes to investing in the stock market. And that is, what actually is stock market investing? So a lot of people will know about the markets, they know about the prices of things, but when you ask like, hey, what is the stock market? It's a very obvious, very simple question, but you'll be surprised at what kind of answers you get. So I want to take this time here to give my perspective on what the market is, and only when you understand what the stock market is, how it operates, what you're actually buying and selling, is that when you're going to be able to actually, I think, have long-term success. Now, anyone could buy something randomly for $1 and it goes up to 40, 20, 10, 5, and you make a bunch of money if you sell. But to be able to do long-term investing, especially value investing, where you're actually understanding the things that you're buying, you really have to have a core fundamental understanding of what the stock market is. And that's exactly what we're going to talk about here. So, step one, what is the stock market? The stock market is an economic instrument where companies that are publicly traded, and publicly traded means they have filed the necessary paperwork, done the necessary financial reviews, and all of those types of things to qualify to be treated as a public company. Now, what does that mean? When a company IPOs, the initial public offering, what's happening is it's debuting on a stock exchange and it's selling its shares to the public. So when you hear about Circle IPOing at $31, what that means is Circle listed on the public markets and its share price was sold starting at $31. Now, obviously, a lot of people saw the price shoot up, and that's market factors. So let's take a step back. A company goes public, and it means that it's selling shares. Like, how does that work? So a corporation has shareholders. Every corporation has shareholders. And those shareholders own the company. So when a company is private, the shares are owned by, it could be corporations, it could be private individuals, it could be employers, it could be the board, the people running the company. The shareholders, at the end of the day, are who own that underlying business. And when a company goes public, they decide, we want to open up ownership opportunities for the broader public. Now, obviously, you can have private market investments and fundraisers, and that's all in like venture capital, private equity, very, very common stuff now. But let's focus just on the public markets, just on the stock market, particularly the New York Stock Exchange, the NASDAQ, those two. So a company lists, and it's going to say, we have, making up numbers, we have 10 million, we have 1 million shares that we're going to be listing for sale on the public markets. And let's say each share is worth $100. So they are selling $100 million worth of that biz, or 100 shares, sorry, 1,000,000 shares at a price that they would like is $100 a share. Now, when that happens, investors can kind of bid up and down the price. If it's a really hot company, like we've seen earlier this year, really hot IPOs, the share price can spike. It can go to 150, 200, 250, 500 right away. If it's not as hot of a company and investors look at the financials and they say, we don't really like this, we could see the price go down to $70, $50, $30. Based off of that, that's how much money the company raises. So fundamentally, companies go public for the main purpose of raising money. It always comes back to raising money, right? So they go public so they can list on a stock exchange, sell shares of their company to the public investors. Could be pension funds, could be endowments, could be retail individuals, someone on their Robinhood. And through that, they raise capital to presumably fund business operations. Now that that point is understood, companies, by going public, what it means is they're selling shares, diluting ownership in that company to the public, and in return, they're receiving capital to then use for other things. Now that that's understood, we have to look at what is the stock market. So the stock market is a bunch of different companies that have all sold off shares, and those shares are being traded by individuals and institutions, primarily institutions. But let's really dive into that. When you buy Apple share for, I think is about $272 right now. When you buy a share of Apple, what are you really buying? You're buying one share out of, I'm assuming, hundreds of millions, and you are granted a piece of ownership in that company. Now, what does that mean? If the company performs well and share price goes up, you obviously share in that appreciation. If the opposite happens, the company doesn't do well, share price goes down, you share in that downside. Now, that's obvious. But fundamentally, this is really the piece. This is the point I want to drill down. People just do not understand what it means to own shares. They say, is the price going to go up? Is the price going to go down? It goes up 100%, I'm selling. It goes down 10%, I'm selling. This is more of a kind of speculative and trading mindset. There's nothing wrong with that. There's plenty of people who make a lot of money speculating and trading. It's a very specific skill, and it's a very different skill from investing. Myself, I've done speculation. I've done trading. I've done it all. I like those things. I think they're fun. I think they're great ways to make money if you kind of have good insight and you have your finger on the pulse of the market. And considering I spend 3-4 hours a day, if not more, on X, looking through all these types of things, I feel like I have a pretty good insight as to what's happening. I don't catch everything, and some things I get wrong, but fortunately, I've been able to get more things right than wrong. But I know what I'm doing. When I'm buying just a hot kind of momentum company that the fundamentals might not be there, I know what I'm doing. And that is just not really investing, speculating, and it's trading. Investing means you look at the fundamentals of a company. You look at their financials. You look at their balance sheet. You understand the general macro trends of where things are going, and you make a calculated decision. I'm going to share in company A because I believe that in the future, company A will be more successful, and that can mean more revenue. That can mean higher profits. That can mean they figure out ways to lower their debt or get cheaper debt so that they're retaining more money. That could mean government policy comes up and makes it way more advantageous for companies in a particular sector. In the previous administration, solar companies were doing really, really well because, there are all these tax credits and subsidies. And when those things go away, the landscape changes, as an example. So I buy company A today for, let's call it $100 a share. And my goal is for that to appreciate. Now, I don't want it to appreciate to $105 10 years from now, because that's going to be a really, really poor return. It would even be better just to probably leave your money in a CD or in a high yield bank account. What you want, and what I do, I'll speak for myself. What I do is I try to find companies that I can buy for $100 today that in 3 years, 4 years, 5 years, 10 years will be worth $150, $250, $500, maybe even $1,000. And it's not, and I don't focus on the share price as like, oh, this company's at $40, it's got to go to 100. That's totally irrelevant, because the share price is what happens when you take the market cap of a company, which means the market capitalization. When you add up all the shares that are outstanding, that are in existence, and you total them, you get a market cap. So a company like Nvidia is worth about $4 trillion. Let's say $190 is the current share price. You take up all the shares of Nvidia, you put them all together, and you'll get $4 trillion. So the $190 price is irrelevant. They can do a stock split, which they have done, and that means it used to be worth $1,000. They split it 10 to 1, and now you get 10 shares when you had one, and each one is worth $100. So focusing on just the share price without understanding market capitalization, without understanding what this price reflects is, I'm going to be very transparent, totally useless. It's a totally useless and actually very detrimental activity. So back to the point of share price. The share price theoretically represents the value of the company. Now, markets on a long enough time horizon should be efficient. That's the efficient market theory. And we've seen that over and over and over again prove to be generally accurate. In short periods of time, there could be irrationalities in the market. There could be mispricings in the market. There could be too much FOMO, too much hype, too much fear, where there's too much FOMO. A company that's like, hey, this company is really worth $10 a share, market cap is maybe $1 billion, is trading at $20 billion because there's a little bit too much FOMO. And if a company cannot sustain those very, very lofty expectations over a long enough period of time, which we see over and over again, the value of the company will start to go down and the share price will start to go down because they're a one-to-one reflection of each other. In a very depressed market, like what we saw back in COVID times, back in April, and even I would say what we saw back in April of this year, of 2025, with the tariff situation, we saw amazing deals. We saw companies like AMD trading at like $78 a share, when for me, it was obvious that that was not the peak of the kind of AI situation. And now we're seeing AMD, I think, up about 200 and something percent since then. And there are plenty of companies like that. So if there's irrational fear, if there's irrational greed, we're going to see price abnormalities. And that's totally fine. And that's where, and this is the beauty of the markets. When you see something is mispriced, either too expensive or too cheap, as an investor, you have the option to either buy it or bet against it. And if you're an amateur, if you're not a very experienced investor, I strongly recommend not shorting. I strongly recommend not using things like options, not using leverage. Because if you are not able to have success and make money, I'm not even talking about realized gains. Even if you don't have like a track record of like unrealized gains, buying quality companies and holding them and seeing them appreciate in a way that's ideally at least matching the S&P 500, if not beating it, I would say you have almost no business shorting stocks because it just doesn't make sense. But the market gives you these opportunities. If there are price irregularities, it's a great time to be, if something is, hey, this company is undervalued, I'm looking at the balance sheet, I'm looking at the income statement, and I know that in 1, 2, 3 years, you never know for certain, but I have really strong confidence that in a year or 2 or 3, they're going to be able to get contracts with these big companies and all this stuff is going to be great. And the revenue is going to go from $1 billion a year to $5 billion a year, and profit margins are going to go from 200 million to 2 billion. If you can find a company like that and you can buy it cheap, that's ways to make generational wealth. And I feel like I've just been doing this a very long time, and I've seen, I've been super super blessed these last couple of years. But companies like Palantir, when people were kind of writing them off, oh, it's not really a game changer. I thought it was a very valuable company, and I was buying below $10. Then I was buying below 15, and then below 20, and then below 25, and then I stopped buying. I don't like to top last. And obviously, hey, if I bought 30, I would have made money. If I bought 70, I would have made money. If I bought at 120, I would have still made money. But you have to have discipline in the markets, and we'll talk about that on future videos. Companies like Palantir, companies like Robinhood, companies like Iron, companies like Hut. These are all companies that I looked at them and saw, I think the market is a little bit mispriced here. And for some of them, it was a lot of bit mispriced. And I was able to buy companies like, and then just more recently, a month ago, I started shorting some of the quantum computing companies, Ionic, Rigetti. I said, hey, quantum is cool. I'm a fan in the future, but we're not even close to having that be realized. And these companies are trading as if they're actually doing these high-level quantum computations that they're not. So I started shorting those, and that's all also played out well. All that to say, to get back into what the market is, to recap and to summarize, the stock market, is a place where companies that are publicly traded, which means they filed all the necessary paperwork, went through the necessary process to be able to sell their shares to the public on a exchange like the New York Stock Exchange, NASDAQ, what it may be. And investors have the opportunities to buy and sell those shares. And they can do a bunch of other stuff, but for purpose of this video, we'll focus on the most fundamental: buy and sell. If you believe in it, you buy. If you don't believe in it, you sell. And that's really what the market is. So the next time somebody asks you about, oh, do you play stocks? Do you gamble on stocks? You say, hey, listen, it's not gambling. There's always going to be a little bit of risk involved with investing, 100%. The world economy can collapse, and obviously all these stocks will go crashing down. But you're buying ownership in companies. When you buy a stock, you're becoming a part owner. Now, a very, 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 very small partial owner, but an owner no less. And the same way that if you buy into a local, one of your friend's local pizzerias, right? Maybe you're going to own obviously more of that than you would have Nvidia or Microsoft or something, but you're a part owner. And, at the end of the day, you make money if the pizzeria does well. You don't make money by, just hype. You could in the short term, but on a long enough time horizon, you make money as a shareholder in a small business the same way you make money as a shareholder in a public company. The company has to improve, the company has to make money, the company has to grow, and the company has to eventually become profitable and grow those profits. That is my thesis on the stock market. That is my point of view. I hope this video was helpful. I'm starting this series really because I wanted to share kind of my experience, and I want to be putting out content. I think there's a lot of great content creators out there on investing, and then in my opinion, there's also some not great content creators out there on investing. And I want to do things in a way that I think are a little bit unique. And hopefully you guys appreciate this. If you like this video, you want me to keep putting out more, which I'll be doing, I would really appreciate it if you smash the like button, smash the subscribe button, leave a comment, and follow me on different social media platforms. Thank you all for joining me. I'm excited to be putting out this video and to be putting out many, many more in the future. I'll see you all next time.